Back in late 2025, it really felt like the crypto market just couldn't lose. The consensus was that it had finally grown up. But then, within a matter of months, all of that confidence just shattered, leading to one of the most brutal crashes we've ever seen. So in this explainer, we're going to unpack that 2026 crypto crash, the incredible optimism, the red flags everyone missed, and the absolute devastation that followed. To really get why this crash hurt so much, you have to understand just how high the optimism was flying. This quote from a major industry report at the time just captures the mood perfectly. And look, the story wasn't just, oh, prices are going up. No, it was way bigger than that. The belief was that crypto had fundamentally changed, that it was now a permanent, serious layer of the global financial system. That was the expectation. And you know what? This idea was everywhere. Analysts were pointing to the flood of institutional money, to clearer regulations as proof that the market had finally left its wild, chaotic teenage years behind it. The thinking was that those insane boom and bust cycles were a thing of the past. And that's so important, right? Because that feeling of safety, well, that's what gave everyone the green light to take on way more risk than they realized. And the predictions, they were just absolutely staggering. For instance, one major forecast called for global crypto exchange traded products, the ETPs, to blow past $400 billion in assets. And it didn't stop there. The numbers just kept getting crazier. The total supply of stablecoins, which are basically the US dollars of the crypto world, was projected to hit $1 trillion. $1 trillion. People saw that as proof of just unbelievable demand. And to top it all off, the world of decentralized finance, or DeFi, was expected to more than double in value to $300 billion. I mean, the story being told was crystal clear. Every single engine in the crypto machine was just firing on all cylinders. So this is the crucial takeaway from that time. The market genuinely believed the old rules just didn't apply anymore. Bitcoin's legendary 4-year cycle? That was history. The new story was that all the big institutional money had permanently smoothed everything out. Deep crashes were a relic. And this wasn't just some fringe theory. It was the psychological foundation of the entire rally. Okay, but while all the headlines were screaming to the moon, some people were looking down and seeing cracks in the foundation. This quote from a strategist in December of 2025 just cuts right through all that hype. It shows that beneath the surface, some people already knew that the whole structure was incredibly fragile, almost like it was just waiting for a reason to break. And when you look back, the warning signs were definitely there, even if they were kind of subtle. For days on end, the big money, the institutions, were systematically selling off their positions right when the market opened. At the same time, the stock market was showing signs of stalling out, and high government bond yields were telling us that big investors were getting nervous and looking for safer places to put their money. And this, right here, is the great disconnect. You had everyday investors glued to the charts, hoping and praying for that classic Santa Claus rally to end the year. But the institutions, the ones with all the data and the most to lose, they were doing the exact opposite. They were quietly selling into all that optimism, heading for the exits before anyone else even smelled smoke. And then it all just snapped. From the peak in late 2025 to the bottom in early 2026, the market didn't just correct, it imploded. Over $2 trillion in value was just gone, wiped out. It's a number so huge, it's almost impossible to really wrap your head around it. So how on earth does $2 trillion vanish that fast? Well, it was like a cascade of dominoes. The first crack appeared right at the peak in October 2025 with a record-shattering $19 billion liquidation event. Then came January, and the nomination of a new Fed chair sent a deep chill through the market, basically signaling that high interest rates, which are poison for risky assets, were probably here to stay. By February, the pressure was just too much, and the floor completely gave out. This chart really just puts the speed of that freefall into perspective. We're talking about Bitcoin's price being slashed by more than half, plummeting from around $126,000 down to below $60,000. And this all happened in just a few months. It was violent, it was fast, and it left almost everyone in a state of shock. So what was the real root cause here? It's easy to want to blame one thing, but the truth is this wasn't a single point of failure. It was a perfect storm, where three massive forces all slammed into each other at the exact same time. So let's break down the anatomy of this crash. We can really understand this whole collapse by looking at these three drivers. First, you had the macro squeeze coming from the wider global economy. Second, you had a crypto contagion that basically started a fire inside the market itself. And finally, you had a total and complete confidence crisis that just poured gasoline on everything. All right, first up, the macro squeeze. With the global economy staring down the barrel of high interest rates for a long time, suddenly safe and kind of boring government bonds started to look really, really good. So put yourself in the shoes of a big fund manager. The math gets really simple really fast. Why would I hold a volatile asset like Bitcoin that pays me nothing when I can get a guaranteed paycheck from the government? It was an easy choice. Sell the risk. Next up, the crypto contagion. The market was just swimming in leverage. I mean, traders borrowing tons of money to make bigger bets. So as prices started to fall, these leverage positions got automatically sold off to cover the loans. That's called a liquidation. And this first wave of forced selling pushed prices down even further, which triggered more liquidations and more in this destructive spiral that just chewed through the market from the inside out. And this was the final knockout punch, a total collapse in confidence. A panic that actually started in the AI stock market, which was just as hyped, quickly spilled over into crypto as investors just started dumping anything that felt speculative. At this point, fundamentals mean nothing. The crypto fear and greed index cratered to 11, which means extreme fear. And when fear is the only thing driving the bus, everyone just wants off, right now, at any price. So after a fire sale of that magnitude, you gotta ask, where did all that money actually go? I mean, it didn't just vanish into thin air. It rotated. It basically fled from the world of digital dreams and ran for cover back in the real, tangible world. And what you see here is a classic flight to safety. Capital just flooded into the old-school, traditional stuff. Industrial stocks, energy companies, precious metals like gold, and of course, the ultimate safe havens, government bonds, and plain old cash. What's also interesting is that even inside crypto, money fled from the really risky stuff into Bitcoin, which acted as a sort of relative safe haven in the middle of the storm. And this table, wow, it really hammers home just how painful that rotation was inside of crypto itself. I mean, a 50% drop in Bitcoin is terrible, don't get me wrong, but it was nothing compared to the rest of the market. Ethereum fell closer to 60%, and many major altcoins, the smaller projects, were just completely annihilated, losing 70, 80, some even over 90% of their value. A total wipeout. So what's the big lesson in all of this? The crash taught a really brutal but timeless lesson about managing risk. It was a stark reminder that when you mix way too much leverage with a portfolio that isn't diversified, well, you're not just risking a painful correction, you're turning it into a complete catastrophic blow-up. Which leaves us right here with the huge question hanging over the market today. Analysts see a couple of big potential catalysts out there, things like a new wave of institutional investment, maybe some real regulatory clarity that could bring serious money back into the space. But the market is still walking on a knife's edge. The fear hasn't gone away. And so the real question is, will those positive catalysts show up in time? Or is the floor about to break for good?